Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I had a question about bonds on the YouTube channel and I thought I would share with everybody else. So the question from James is, can you talk about bond investment choices in Canada for individual investors who are retired, please? Thanks. I should stress, please do your own research on this matter before deciding on what you would like to invest in. But let's give you some basic bond information. So bonds are loans to government or to companies which pay interest, also called a yield. There's 3 broad bond classes. You have your safe government bonds, which are low risk and low yield. You have investment grade corporate bonds, which are loans to companies, generally higher risk, with a higher yield than the government bonds, but still reasonable risk of you getting your money back. And then finally, we have a high yield junk bonds, which is high risk and high yield. As interest rates go up, as they are now, new bonds need to pay more interest, so fresh money is going to get better returns in new bonds than in the old bonds. Existing bonds with lower interest rate returns need to be discounted, that is a capital loss, to account for their lower returns compared to the new bonds when they're sold. Therefore, there's a price risk with rising rates. Bond duration is the date of the bond expiry when the lender gets their money back. This can be 30 days to 30 years. Short duration bonds have fewer payments to be discounted, so they take less of a hit from increasing rates. Longer duration bonds will be harmed more by the rising interest rates. Please do see your accountants about this, but at a high level, bonds are taxed as regular income if you have them in a non-registered account, and so generally it is wise to have your bonds, if you do want to have bonds, in a TFSA or an RRSP. So what is happening today? Investor money is going into Canadian aggregate bond ETFs and other investments. Near cash-like income space is the most popular today, meaning low duration bonds. A few years ago, buyers were buying bonds for safety and no income because the interest rates were low. Today, buyers are buying for income as the rates come up. Also, the Canadian government bond yield curve has inverted for the 2-year and 10-year bond yields and will invert even more. What this means is that longer-term bonds pay less than short-term bonds, which is unusual. Generally, longer-term should pay more because the money is at risk and out of your hands for longer. So as requested, I do have some suggestions for James. There is a significant spread, meaning difference, between different expiries/durations you can take advantage of as an investor, going for shorter term, around 10 years duration or less, that yield more than the longer term because of the inflation expectations being high for the shorter term and easing into the longer future. I'm seeing growth opportunities in the 10-year maturity corporate bonds that Canadian investors should be taking advantage of with these attractive valuations. A global growth slowdown is looking pretty clear at this time, and bonds will benefit. Valuation on corporate bond yield and total return hasn't been this high in a decade. Fundamentals are based on future growth, ignoring the short-term inflation, and are looking further ahead. The bond markets are expecting rate cuts in 2023 when the central bank overdoes the rate hikes in 2022. Looking out even further, if the world is in a low level of growth, the bonds will be doing very well. Corporate bonds are good because Canadian corporations have pricing power and are likely to do well and avoid defaults. The balance sheets are strong in Canadian corps, but their bonds pay higher yields than government bonds while being nearly as safe. the spread between the two is compelling towards corporate bonds. Many of the corporations, especially lately in the energy sectors, may not need to refinance the corporate debt because they have so much free cash flow and they can pay their debts off. Investors will be looking to buy more corporate debt with higher yields, but there won't be much available, thereby bidding its price up. Bonds are not meant to be big earners in a portfolio, but rather than the safety and the ballast. With the higher yield from fixed income today, you may be able to get similar cash flows as you can from dividends on stocks, yet with less volatility. So that concludes my thoughts on bonds. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.